Money Vikings, welcome back. Money Viking Greg here. I want to do a quick overview of some ideas as we continue to design our portfolios for the next administration and kind of deal with the ever-changing world. And what I want to do is I want to blend this with comments from Tom Lee, as you can see here on the screen, of Fundstrat. And I do put a lot of stock in his views and his conviction and his advice in terms of investing. He's quite right most of the time and quite level-headed about things. This is not to replace the fundamentals of investing and our Ride My Bike portfolio, which I strongly still believe in and I'm going to continue to add to and to use forever. So it's not that I will never change anything about it, but I don't change a lot of the core things about it. The moves I make are strategic and they're just sort of adjustments here and there, but they're not knee-jerk reactions to things. So I'll give you a quick example. So the Ride My Bike portfolio is essentially a diversified portfolio, and it's very common sense. Like it's got, I'm using round numbers just for the sake of discussing here. It might have 30-40% in the S&P 500, which I'm going to dollar cost average into and just continue forever. It's a future passive income machine. I never bet against the US. I think over the long run, it's fine. Is it shooting up too fast right now? Probably. Will there be some corrections? Probably. But I think over, 10, 20, 30 years, by and large, it's going to continue to climb at some rate. Maybe not as much as it used to, but it's still going to go up, and I think it's a good solid foundation. So from there, I like to diversify into things like the SCHD, which is the Schwab U.S. Equity Dividend Fund. I like some of the Vanguard Dividend Appreciation Fund, the VDADX. And you guys know that I like some real estate exposure. And I like a little bit of bonds too, just for maybe some stability and to just continue to collect the yield. But I think Tom Lee made some good points about the next administration might be a catalyst for small caps. So what I did is I did add some small caps. And at times I might also get a little more defensive. So if there's been some sort of, euphoria run up of something, I might take a little bit of money off the table. Because anyway, it goes back to that old adage, be greedy when everyone is fearful and fearful when everyone is greedy, right? And it even reminds me a little bit of Bitcoin right now. So right now, everyone's going to pile into Bitcoin. And I do like to have some Bitcoin exposure, but I'm not going to put everything into it. And if it gets rather high, in my view, I will take some money off the table. So anyway, those are just some of the strategic moves that I make. And they're not knee-jerk reactions. They're just sort of adjustments here and there at the edges. So let's play a little bit of Tom Lee and let's hear about a couple things. I do want to talk also about his Granny Shots ETF.
S&P target for year-end 6,300. Great to see you, Tom.
Great to see you.
You like to call them granny shots, easy plays. In your view, I have to imagine that list has gotten longer.
Mm-hmm. Yes, it is. But it stayed around 35 names, but just high-quality names that are in the right sort of themes. We have 7 themes, and as long as they're in more than one theme, they become a granny shot.
Higher conviction on those names, I imagine.
Yes, higher conviction, and these are names that I think most people are going to be familiar with because they're large cap stocks.
So I did also add some of exposure to this new ETF from Tom Lee. So as you can see, it's GRNY. The top holdings are there. And I do like the concept. He calls them granny shots because they're sort of the easy large cap wins. And there's something to be said about that. It's very level-headed. You're looking at very large companies that make a ton of money, probably in a good position, and will most likely continue to do very well over time. I mean, you have things like Costco, Caterpillar, Chase, Emerson Electric, etc. Let's watch a little more.
Discussion about cyclicals today. That they make sense, and a lot of people are looking to 2016 for analogs, but some argue that there's not the commodity price support that you might have had in a prior cycle. You buy that?
You don't necessarily need commodity prices to help cyclicals.
Oh, yeah, energy, but even materials to some degree. Some are.
Yes, that's right. Yes. So for those, I would say yes. I'd say the outlook for energy stocks isn't great, as good as people might expect under a Trump presidency, just because expanded drilling is lower oil prices. But for cyclicals like industrials and financials, this is, for all the things you guys were discussing, a great environment, including.
So read between the lines of what he's saying. It's very interesting. We shouldn't just assume that the next administration, this sort of common sense things that we think will just do well will, because there's really no guarantee of that. So that's why I continue to like to have a ride my bike portfolio that looks out way beyond any administration. And again, it goes into some of my earlier commentary on the channel where I talked about how I really don't like to make investing decisions based on political parties. What you'll find is that the S&P 500, so let's take that as a benchmark, it's the 500 largest companies in the United States. It's self-cleansing. Those that are weaker fall out of it, and those that are stronger go into it. You're going to find that it goes up over the long run, no matter who the president is or who's in Congress, et cetera, et cetera. So, it dips sometimes, but people sort of put blame on different administrations that it's a little bit misplaced. I understand, the need to create order out of chaos and the need to blame someone and to make a change. And that's fine. That's just the way the system works. But it usually doesn't make for very good investing decisions in the long run.
And cost of money falling and animal spirits and deregulation.
Do you think there is real reflation risk in the next, say, 6 months?
That is something that we can see how markets are repricing, and there's a measure called 1-year inflation 1 year forward. So what does markets think 1-year inflation is a year from now? That has been creeping up. It's actually now at 3.6. It's been a trigger point in the past where the market starts to worry. So whether it's the deportation that's causing that or fiscal spending, I'm not sure, but it is, markets are starting to think about it.
So that's another theme that I'm going to hit on for a while here, is that I don't think inflation is going away anytime soon. As we know, inflation was caused basically by the pandemic, and it was caused by disruptions in trade, and it was also caused by the release of stimulus money, right? And then there was also really low interest rates. So anyway, we had an inflationary period, as we know. That's been coming down quite a bit. Inflation, I think core inflation is down to about 2.5%, which is very good, actually. That's very healthy. But when the prices of things rise, they stay high for a while. And I really think what needs to happen is that incomes have to try to catch up over time. But what he's trying to say is inflation isn't gone. So I'm going to continue our inflation defense systems at Money Vikings that we've talked about many times, buying in bulk, cutting things out, cutting unneeded subscriptions, etc.
Just better growth outlook could help inflation expectations rise. I guess where Trump trade 1.0 ran into trouble was around trade policy. And once we see what he delivers there in terms of tariffs, something he's been very, very consistent on, do you think the market is looking past that, or everything else, the deregulation, the lower corporate taxes, is going to...
So the final thing I want to end on is this. I would also not make a lot of investing decisions based on macroeconomics, right? And I know there's a draw and a pull to do that. But again, if you are an average wealth builder investor, if you are buying sound assets and you have a diversified portfolio, we're probably going to be just fine. And so all these things, all these macro trends and tariffs and this and that, I don't know. No one knows how it's going to play out. But I can tell you this. People are still going to live. They're still going to consume. The 500 largest companies in the United States are still going to do fine, and you're going to have a self-cleansing, investment vehicle that's going to work fine for you in the long run. So I'm just going to try to keep a very level head about it. And the final thing I'll talk about, which is on the ticker here, is Bitcoin. So Bitcoin is surging. Money Vikings called it. We called that it would start to skyrocket. A lot of that is based on, I guess there's a concept out there that the Securities and Exchange Commissioner, when the new administration places a new one in place, they're going to create rules around cryptocurrency. And I guess Bitcoin and crypto investors have been looking for rulemaking for quite a while. So they're looking for that that as a positive signal. So I'm definitely seeing, or I believe personally, that crypto and Bitcoin is going to hit 100,000 And, and at the end of the day, it seems like the main use case is the idea of scarcity. It can't be printed. So as, debt levels go up and as money's printed and et cetera, all those kind of shenanigans, I think people will look for a place to park wealth that is something like a Bitcoin, which at the end of the day, the bottom line is I see it as digital gold, right? So gold holds value because humans see it as scarce and it has scarcity. So anyway, that's the system. You got to play the game. But again, with Bitcoin, I'm not going to go nuts. I'm never doing more than 1 to 2% of total assets. I just think that's just where I'm at. That's where my risk tolerance is at. So hey, hope you got something out of this. Have a great week, everybody. Please like and subscribe and all that great stuff. And we'll see you on the next one.